Good afternoon, everybody. Just bear with us as we always do and let the participants join. So please, there's no issues if there's silence for the next sort of 60 to 90 seconds. Bear with us as the participants are joining the session this afternoon. Right, good afternoon to everybody and a very warm welcome to the first Institute's 60-minute webinar of 2023. For those members who join us who work in practice, I do hope you survived the self-assessment season. For those in business, no doubt you've been kept busy for a variety of other reasons, but it's a pleasure to have a good number of you join us this afternoon for the first 60-minute webinar of 2023. For those of you who are old hands at attending, contributing and listening to the Institute's webinars, and to those of you who may be new, just some housekeeping points, if I may. If we have any technical issues, any problems, I will do my best to resolve and sort those as efficiently and as effectively as possible. Please bear with us if anything does untoward happen. But can I make the suggestion that if you're having audio or visual issues, you might want to check your own Wi-Fi or your own connectivity, because from previous experiences, I've often found that that's the problem, that's the issue. So please, if there are any issues, bear with us and we will resolve those as efficiently and as effectively as possible. Today's session is being recorded and we will share the session with everybody. It'll probably be at the beginning of next week that we share that, when a colleague of mine returns from annual leave. These sessions from experience come to life where members use both the chat and the Q&A box
Apologies, I always seem to have lost Jonathan there. Hopefully he'll be back with us imminently. I'm going to do now, while we just wait for him to get back with us, I'll do now what I was planning to do at the end, and I'll caveat that with an apology if I sound a bit funny, because I've just got out of the dentist and I was hoping the local anaesthetic would have worn off by the time I got to speak to you all at the end of today's session. My name is Matt Barton. I'm the IFA's new technical manager, which is a post that is new to the Institute, as well as being new to myself as well. So this is the first one of these 1-hour webinars the IFA does that I've had the privilege of coming along to. You should see more of me at these, probably hosting them alongside or in place of JB, IT permitting, of course. And I'll just take this opportunity, just a couple of minutes before we crack on with the webinar as a whole, to just, because it's a new role to the Institute, say just a few words about what the role's intended to do. A few things, four pillars, I would say, to the role, as I see it. First one being technical support, which is sort of summed up in the job title, right, of technical manager. Reviewing, iterating, improving, maintaining the IFA's technical support offer to members, so that you all can be effective and efficient in your practice and in industry where appropriate. Ensuring that it's tailored and up to date and current and relevant for those of you working in the SME and SMP space, as of course our members are, and as of course we focus on. Besides the technical support, CPD is another thing I've been brought in to look at and where possible to expand. Jonathan has some slides that when he does join us again, we'll run through showing what's coming up in terms of CPD over the next 6 months or so. One of, or really my primary objective in terms of looking at our CPD office, to look at how we can expand that beyond the very popular, and rightly so, series that we already do regularly on tax and AML and other regulatory issues, alongside the shorter 60-minute webinars we do, as we are doing today as well, to look at expanding into, I suppose, advisory, management accounting, business partnering, business support, in that sort of advisory as well as compliance space, I suppose, to help, again, you, our members, to tailor your offering in a way that is most effective for you and the clients you're working with, and to differentiate yourself in what remains a competitive marketplace. Recognition being the third pillar of the role, making sure the IFA and its members get the recognition and respect that the IFA credentials deserve, and advocacy, being involved in, among other things, a wide variety of government, particularly HMRC panels and working groups, to make sure the IFA's voice is adequately heard, and by extension the voice of IFA members, SME, SMP focused accountants, with the market leader for that in the UK. So it's very important that our voice and the voice of our members are heard when the government is considering, among other things, how to implement NTD for self-assessment when it does, even when it does get the full rollout. Just an example off the top of my head, there's currently this consultation going on around R&D reliefs, any and all kinds of government consultations that are ongoing now and are upcoming in the future. Right, so I don't want to take any more of your time. I want to give an opportunity to get into the webinar, and during which time I'm gonna go on mute and see if I can track down JB. He's in our head office today, so I would assume the internet will be back up and running shortly if it's not already. But just to say before I do that, thanks very much everyone for coming. I'm Matt Barton, I'm the new IFA technical manager. When we get Jonathan's slides up in a moment, probably at the end of the webinar now, put my email address up on there as well. Please do get in touch, particularly if you're interested in talking about anything in the technical support, CPD, recognition space. If you'd like to get involved with the advocacy consultation side of things, I'm all ears. I want to hear what we can do better for you going forward as well. So as I scramble to take over hosting this webinar without adequate preparation, would our assembled panelists first of all, I suppose, like to introduce yourselves, and then we'll crack on.
Sure, thank you, Matt. So hi everyone, really happy to be here with you today and look forward to talking about what we do as the community development finance sector and hearing questions from you. So to start off, I'm Theodora Haji-Michael, Chief Executive of Responsible Finance. Responsible Finance, like the IFA, is a membership association, and our members are lenders called CDFIs, which I'll talk about after everyone's introduced themselves.
Afternoon, everybody. My name's Andrew Ostwick, and I run Finance for Enterprise based in Doncaster. We are a CDFI, Community Development Finance Institution, based in the north of England, but more latterly covering the entire space in the UK when it comes to lending to SMEs. And I'm joined by my two colleagues, Senior Business Lending Manager Tim Daniels, and we've also got Business Lending Manager Jeremy Meadowcroft here today as well, so I'll hand over to them.
Hi, as I said, I'm Tim Daniels. I carry the title Senior Business Lending Manager. Hopefully the title reflects experience and not age. I've been with Finance for Enterprise for 10 years. I had 35 years working for Barclays before that. And I've seen the business evolve from my first year, where I think the business lent shy of £1 million with an average loan size of £25,000, to a business now, as Andrew said, which is probably perceived as a national funder of SMEs, where average loan size is, and Andrew will correct me, but in excess of £125,000. So that's a short summary of me. I'll let Jeremy say a few words about himself.
Well, just briefly, good morning, everybody. My name is Jeremy Meadowcroft. I'm, like Tim, a business lending manager here at Finance for Enterprise. So we deal with the clients from start to finish. I'm ex-bank manager, worked for Lloyds for 28 years, Santander, a little while in corporate, and then came into the world of CDFIs, as Theo is going to explain to you all, about 6 years ago. And I love this field.
Jeremy,
thanks everyone for. Oh, sorry, JB, you're back with us. I'll let you.
I'm sorry. First,
we filled a bit of your absence with. I gave my introductory spiel as the new
brilliant,
manager.
excellent.
Just rejig things a bit, and everyone's just got through introducing themselves. So perfect time to rejoin us.
That's fantastic. Thank you very much. And I do apologise. I'm glad the introductions have been done. Famous last words about housekeeping and technology. Many apologies. Thank you to the panelists and to Matt for covering for me. Theodora, can I hand over to you? I know you're starting the slides and the presentation, so thank you very much indeed.
Yeah, thank you, Jonathan, and good to see you come back. Happy you're able to make it. So I hopefully you can all see that. Someone from the panel, please do shout if you can't. But like I said, I'm Theodora from Responsible Finance, and we're really grateful for the opportunity from the IFA and Jonathan and Matt and the team to speak to you today, because we think there's a lot of area for collaboration between our two memberships to help SMEs and small businesses access the finance that they need. So I'm going to briefly tell you about what our members, CDFIs, are, what they do, what they exist, and then, as we said, we'll hand over to Andrew and his team, because they're really the experts and they can bring it to life for you. So to start off, I'll start with the stats on why CDFIs exist. So I think probably the numbers on this slide are not a huge surprise to all of you, and you probably all deal with this in some form, but in the UK, there's an estimated over 1 million businesses, and that's 1 in 5 businesses that have difficulty accessing finance. And those barriers, we know, are greater for certain business groups like women, ethnic minorities, and SMEs located in less affluent areas. And that's why CDFIs exist, and that's why they were set up. And CDFIs have a 20-year plus track record of filling these gaps across the UK. So to tell you a bit about what a CDFI is, because you may not have heard of them before, CDFIs are not-for-profit lenders that provide flexible finance. They're not-for-profit and social enterprise because we fundamentally believe that a lot of the businesses in those stats, the 1 million businesses, even though they've been declined or even though they struggle to access finance from lenders like banks, we fundamentally believe that they are viable and that no can become a yes. You know, one thing I can share with you is that we know from our members over 9 in 10 of the businesses that CDFIs lend to have previously been declined by a bank or another lender, but over 90% of those go on to fully succeed and repay their loan with the CDFI. So I think that's really strong evidence that a lot of those businesses are viable, and CDFIs are here to give them another chance and support them in their journey to succeed. CDFIs do that by they're different, they look different from other lenders, and you'll hear that from Finance for Enterprise, but they take more of a relationship-based approach. They lend to a range of businesses, whether it's startups, established businesses, or even some non-traditional models like social enterprises. To tell you a little bit about our membership, so there's about 30 CDFIs like Finance for Enterprise operating across the UK. They lend about 170 million pounds per year to small and micro businesses. And over the past 5 years, our members have lent over £1 billion into underserved communities that haven't been able to access finance elsewhere. So we're really proud of the scale at which we've been able to support communities and businesses to date. I won't dwell on this too much because I think this is what Andrew, Jeremy, and Tim are here to talk to you about, how they turn that no into a yes. But the thing I do want to stress is that CDFIs are not like banks, so they are not shareholder-driven organizations that need to lend these massive amounts and massive volumes using algorithms. They are located in the places, CDFIs are located in the places that they serve, and that means they can go meet the business. They take more of a relationship-based approach. They kick the tires, and that's why they're able to tackle some of the common reasons we hear that businesses are declined. So, for example, things like uneven trading history, which is not that uncommon given the past 3 or 4 years that we've been through. CDFIs are able to work with the business, really understand what the drivers of that trading history have been, and understand the assumptions, work with the management team to really understand the business's viability. And in a lot of cases, that's able to turn the no into a yes. Our members are located across the country, so it's very likely that there is a CDFI operating in your area. While I think the products across these 30 different organizations are different, this is just to give you a high-level overview of what the average is across our sector in terms of what the terms are on the different types of loans. And I think what hopefully you'll be able to tell is that CDFIs are very flexible and tailored in their products, and they adapt their products to the type of business that they're serving. So whether it's a startup, whether it's an established business, or whether it's a social enterprise. And then finally, just to finish off, I could probably talk to you all day about how good CDFIs are at what they do and how impactful they are with the businesses that they work with, and help open doors for them through giving them access to finance. But I thought it'd be probably better if a business spoke for itself. So here's a quote from a recent CDFI customer last month who was looking for finance right before Christmas to buy some new stock, and they looked at a number of different loans and credit cards which were more expensive, and they were able to get a loan from a CDFI. And what they said is, I felt from the first point of my window's blocking it, sorry. From the first point of contact to completion, I felt very supported and guided through my application process. And I hope that gives you a real sense of how CDFIs work to help their customers be successful and unlock opportunities for them to grow. And so finally, thank you so much for having me again today. I'm really looking forward to hearing your questions and finding out ways we might be able to work together more. If you want to find out more, you could go to our website, and we also have a directory of our members called findingfinance.org.uk. So you can go there to find the CDFI that's closest to you. And I hope you do check that out. So thank you again. And I'm going to stop sharing and hand over to Andrew now. Thank you.
Theodora, thank you very much indeed for that introduction. Andrew, can I hand on to you, because I think it sort of dovetails quite nicely from what Theodora started out with, and you and your colleagues are then bringing that to life in another guise.
Yeah, afternoon. Thanks, Jonathan. Yeah, so a bit more detail, really. I'll expand on what Theo said, and yeah, hopefully I can give you a bit more information that brings this to life a little bit. So just to drill down a little bit further, yes, we are a CDFI. We're a not-for-profit company. Most CDFIs are. So we don't have shareholders. So we're not doing this necessarily to make money. That's
I've lost Andrew. I
We've
do.
lost
Andrew.
Andrew. Okay, well.
Spokesman for Finance for Enterprise said.
Can you give me screen sharing, in which case I can pick it up?
Yeah, right. Bear with me. Right. Technology, my word.
Andrew's
Yeah.
back.
Oh, is he back? Okay, great.
Zoom bugs strike again. Sorry, folks.
That's okay.
Right, hopefully I'm back now for the long haul. So yeah, I'm not sure how much of that you caught, but I was just explaining that we're not-for-profit companies, generally CDFI. So what we do isn't through the lens of profit. What we're doing, and looking at the model there on the right-hand side of the screen, we're doing this really for the betterment of the local economies that we serve. So any surpluses that we do make through our lending operations, we reinvest back into further lending. So we hope to see this snowball effect where we can grow, we can extend our reach, we can help more businesses, particularly at times like at the moment where there's a lot of economic headwinds. So
can I just, sorry to interject, I think with you, losing you, we've lost your slides as well. So you might just want to reload those. Apologies.
Right, okay, just give me a second, Jonathan.
No worries, no worries.
Right, is that coming through at your end now, guys?
Just bear with us.
There we go.
There we go. Yes, thank you.
Happy days, we're back in business. So yeah, what gets us out of bed in the morning? I mean, I'll fess up. I'm a reformed bank manager. That used to be my previous career, as were Tim, and he heard from Jeremy earlier as well. And I think we became a little bit frustrated. Sometimes we're having to say no to clients when we felt the right decision was yes, because banks are run for the betterment of the shareholders to create a commercial return. So really what we do, what our craft is to turn what's been a no to a client from another lender into a yes. And how we do that is by doing further due diligence, by expending more time and cost really in speaking to that SME to find out what's going off in that business, to make a more informed decision effectively. So it's more labour intensive, but that's how we arrive at a yes when other funders have often said no. Now, we have to say at this point that sometimes no is the right answer. You know, if a bank said no, maybe a fintech's had a look at a proposal and they've also said no, maybe that's not a viable business. So it could be the case that Finance for Enterprise may say no too, but that's from an informed position where we've asked the right questions. We've tried our utmost to see whether or not there is something that we can get behind and get behind that business with a loan effectively.
Andrew, sorry to interrupt. You've got a message on your share screen. Can you just knock it off? That's it.
Yep, is that gone now?
Yep, great. Carry on.
Okay. So what do we do? This is CDFIs in general. Well, we provide loans, as Theo said, when banks and mainstream funders can't. And there's two kind of scenarios at play here. Either the bank or the mainstream funder doesn't want to help at all. That's the first scenario. So we'd be providing 100% of the finance that SME needs. Or perhaps my preference is where we're part of a wider funding package, where a bank has provided some of the funding that the business needs, maybe some asset finance is going into the proposal as well. But there's just that last piece of the jigsaw that needs to be slotted in to unlock that growth, that good opportunity for that SME. And that's our favoured position, really. If we can be that final lender that brings a deal together, everybody's happy in that little situation. The borrower business is happy because they've got their ultimate total amount of funding required. The bank's happy, they've only done the funding that they were prepared to do as well. And we're really happy because we unlock that finance, we help that SME move forward. So that's our real preferred situation to be in. So how we lend, you can see the loan range that FFE has there, £25,001 up to £250,000 in total. The two little tiles you can see on the right-hand side, that's predominantly how we lend money. The recovery loan scheme through the British Business Bank, which is now in its third incarnation, we participate in that. That is the tool to help us say yes to clients when other institutions have said no. And we also deploy some regional funds as well for the British Business Bank. We deploy the microfinance strand of the Northern Powerhouse Investment Fund, which is targeted towards growth businesses creating jobs in the north of England. And that's a really good product to help those businesses. So we often sometimes provide a blended approach where we're not just providing one strand of funding, perhaps we're providing maybe 2 or 3 different individual strands of finance from the various different pots that we have to ultimately service that client's borrowing need. The thing that we if you look at our sweet spot, is that we like established businesses, typically trading 3 years plus, that can show an ability to repay, not necessarily through historic financial accounts, but sometimes through management accounts. After the COVID pandemic and certainly the economic headwinds we've got at the moment, we like to be able to see some sort of a hockey stick going off, or ideally a more sustained Nike swoosh going off in that business's financial information. that we can get behind, we can back that business, we can see that the trends are turning positive, they're going up again. So who do we help? Well, ultimately, we're here to support trading businesses, SMEs, that's businesses with less than 250 staff that are in some way underserved. We don't do things like development finance for property developers. We don't do commercial buy-to-let funding. That's available in the market elsewhere, sometimes cheaper and quicker than we can provide. So those kind of borrowers are well served elsewhere. But yeah, any purpose is eligible. I've got to put a caveat here. It's got to be legal. It's got to be something that our funders, when we're using their capital, will be happy with. So for example, we wouldn't fund anything related to tobacco manufacture, anything to do with things like animal testing, ammunition manufacture, anything like that. But generally anything is eligible. And what we do see is we're generally funding working capital requirements for SMEs at the moment. We're fairly sector agnostic. We realise that there's certain sectors at the moment that are perhaps higher risk than others. So hospitality, retail, leisure, industries that require a good discretionary spend from households, we realise they're high risk at the moment, but you get good operators in high risk sectors. So again, we're prepared to look at those kind of proposals if we think we've got a good operator that can repay a loan. If you look at the final 4 bullet points I've put here, I mean, from my banking days, that we've got the 4 S's here: serviceability, security, stake, and suitability. Now, it's typically for one of these reasons or a combination thereof of why an SME can't get mainstream finance from a fintech, a bank, or another tertiary lender. So I'll just walk you through some of the reasons why. I mean, serviceability is often a reason why Finance for Enterprise is asked to provide a loan. A lot of lenders look backwards. They take the most recent financial accounts, which might be up to a year, 18 months old, and they base today's borrowing requirement from that business on last year's trading performance. But we have to recognise that sometimes last year, that business didn't have that really great contract they've just won now. And last year, perhaps they weren't putting that mezzanine floor in for that extra machine that we're going to be asked to fund that will boost their output and revenue. So we take a pragmatic look at exactly how this loan is going to be serviced. And sometimes that might require forecasts. We're a projection-led lender a lot of the time, where we're saying, okay, you explain to us how you can afford this loan if it's the case that last year's financial accounts don't demonstrate a loan being serviceable at this point in time. Second common reason is security. We tend to lend, as I've said, against the recovery loan scheme, which is when there is a deficit of security available in terms of tangible bricks and mortar to underpin a deal. So often banks will lend and will say, okay, we're happy to provide £300,000 towards an overall £500,000 request to an SME, looking at what our written down value of security is, or what we feel our debenture may be worth if we've got that kind of security available as well. But there could be a gap based on what that property is being valued at, or that debenture is being viewed as being worth. So consequently, we look at the headroom in the business to pay back rather than just what is the value of security, and we'll look at pawnbroking that effect. The next thing is stake. We're often brought into proposals where businesses do have cash to put towards the purchase of a new machine or a new property for them to trade from, but at the moment, I think a lot of SMEs want to hold on to that cash to give them options. There's a lot of things going on in the economy where I think SMEs don't want to get caught short with rising energy costs, rising interest rates. So we often get brought into a proposal to say, okay, let's keep the liquidity within the business, but can we look at effectively providing 100% funding towards a proposal to keep that powder dry, keep that cash available to the SME should it need it in the future? And the final one of the 4 S's is suitability. I mean, we're often asked at the moment to look at refinancing unsuitable debt that was perhaps quick fix finance through the pandemic, which an SME is able to service, but it's now providing a drag on that business. It's blocking cash flow growth. We sometimes see that SMEs have had credit issues, or the directors have had former credit issues. As long as we can explain those and the logical explanations, we can get behind it. Sometimes it's the loan purpose which is an issue for the bank. Sometimes if it's being asked to fund growth, things that perhaps aren't tangible, like a marketing drive, that's sometimes less easy for funders to get behind than if it was just to fund something a bit more vanilla, like a new machine or a vehicle or a property. And the final thing we see a little bit at the moment, which is why mainstream funders take a swerve on a proposal, is sometimes there's HMRC arrangements in place. Now, clearly that shows us cash flow pressure sometimes within a business, but that's not necessarily a complete no-no for CDFIs. So from our perspective, we need to understand why that happened. Is that an agreement that's locked down with HMRC, that's been agreed to, and is it being maintained? Is it affordable going forward? So that's not necessarily a blockage for us providing finance. So a little bit more specifically about Finance for Enterprise and what we do. Well, I think it says it on that slide, really. We want to unlock businesses' potential. That's what we're here to do. So a bit more about the specifics. So yeah, we've been around for a while, 37 years. We're incorporated in 1985 and really Doncaster, which is where we're based. I mean, I'm sitting in a former business banking centre that we purchased 3 years ago. So you can see how the banks have retracted and we're trying to backfill their position in local economy. But yeah, Doncaster, which is where we're based and headquartered, was the centre of our donut. And over the years, over the last 37 years, that's kind of expanded to be South Yorkshire and then Lincolnshire and then the north of England, all the way really from north to south these days because of the introducer network that we've got. So our aspirations are to deploy more money. We know if we have a good year and we put £15 million out to market, that's still not really scratching the surface of the businesses that go unfunded that perhaps ought to gain funding in the scope of the whole UK. So a major thing we like to do is we like to safeguard and create jobs. That really does chime with our funders, how they measure our performance effectively is whether we can get good outcomes for local economies and UK PLC. And just to pick up something that Tim mentioned, if I look at the rolling average over the last 3 months, our average loan to SME borrowers is 141,000 at the moment. Giving you a bit of flavour here about how we work. I mean, we charge a 3% arrangement fee, and the thinking here is that is to cover the staff costs and time, the cost to serve that client borrower in doing our due diligence, which is often a little bit more in depth than a mainstream funder. We'd like to provide a better outreach, a bit more support, really wrap ourselves around that business to help them out and guide them through the process, and sometimes help them get investment ready as well. That's a big part of the jigsaw sometimes to unlocking that finance for the SME. If we look at our current interest rates, we currently price our loans from a standing point of 14.39% on a fixed basis. That's been somewhat suppressed by the recovery loan scheme, which has a 14.99% overall interest rate cap through the British Business Bank, but that's currently being reviewed. Now, as it stands at the moment, we're sometimes a little bit cheaper than other funders in the market, which is not really the position we want to be in. If a loan could be leveraged through Funding Circle, for example, we don't really want a client coming to Finance for Enterprise to borrow that money instead or in lieu of getting that loan elsewhere in the economy, just because perhaps we're a little bit easier to transact with or our pricing is cheaper. So that's just something to bear in mind for the future as the BBB, British Business Bank schemes are tweaked. So this slide is just to give you an idea of who we've dealt with in the past. I mean, our major backers in terms of what we do is to provide onward lending capital to borrower SMEs. We've got Triodos Bank, Unity Trust Bank, 2 social banks in the UK that have been really helpful. We've previously borrowed from Co-op as well in years gone by, European Investment Fund, local authorities as well. But the 2 major pieces of scaffold that really held up CDFIs is the guarantee mechanisms and some of the regional funds that we get through the British Business Bank. And you can see their logo on that slide there. So that's where we started off. That was our business effectively, I think probably back in the late 80s, I think, looking at that photo. But we're previously called Donbac, Don for Doncaster, BAC, Business Advice Centre. And that was our shop on the high street in Doncaster, giving support to local SMEs. Because we've changed a little bit, this is our current office as we've rebranded. We've removed the geographical reference to Doncaster as we provide loans throughout the UK. But yeah, we're a growing business and we think we've got more work to do moving forward. So at this point, I'll hand over to Tim and Jeremy, 2 very experienced lenders who have been in our team quite some time, just to walk you through, well, in total 6 deals that they've transacted recently, to explain why we were asked to help, what we're being asked to do, perhaps what the barriers were to that SME getting the finance elsewhere, and how that helped those SMEs really move forward and get some positive outcomes.
Andrew, thank you. Before Tim and Jeremy come in, I've got a question, and I think it's a pertinent time to sort of ask it. And the question's quite simple. How long is the loan term?
Yeah, well, it's up to a maximum of 5 years at the present time, Jonathan. So it's very unusual for us to do a loan less than 5 years at the moment. I think a lot of SMEs keep their options open and they'll say, can I have 5-year money? And they often say they'll try and repay us early. Doesn't often happen, unfortunately, but there are no early repayment charges. So if an SME does find that cash flow's worked out a little bit better, or even more ideal, they can go back into mainstream funding and repay our loan so we can help another SME. There's no barriers to a borrower business with ourselves doing that. We're very flexible.
Okay, no, thank you. And also, do you look for both a mixture of business and personal guarantees when you're transacting with an SME?
Yeah, I mean, we haven't through recovery loan scheme phases 1 and 2 in CBILS. We couldn't. That was part and parcel of the scheme terms. Now, we are permitted to take a full personal guarantee if we're lending to an incorporated entity under recovery loan scheme 3 via the British Business Bank. We've chosen not to do that. We take a partial guarantee. I think it's probably a little bit unfair to ask SME owners and entrepreneurs to shoulder all of the risk of their businesses' borrowings at the moment when there's so many trials and tribulations and things going against SMEs out in the marketplace. We don't think that's fair for them to shoulder that entire responsibility. So we ask for a partial guarantee. So we ask for 25% as a guarantee from the principals in the business. So on a £100,000 loan, we'd ask for a £25,000 guarantee at face value from the director owners of the business.
Okay, no, thank you.
We're kind of splitting the risk. We like to have a bit of skin in the game,
Yeah.
but we're not asking really the entire debt to be underwritten by the directors.
Okay, and the speed, an inquiry comes into your organisation. From inquiry to the funding then being made available to the SME. Everything's different, but what's the average time?
Yeah, I'll try and answer that. I mean, every case is different. I'd say from once we get all the information we need to fully understand the proposal, ratify the borrowing request, get our head fully under the bonnet to understand that business, I think from end to end, we're talking about a week. So It's not too extended. But I mean, from Tim's perspective and Jeremy's perspective, if they're writing up a piece of credit and that's hitting our underwriters, we'd be expecting a decision in 72 hours on that loan.
Yeah, thank you, Andrew. Sorry, I'll let you continue, or Tim and Jeremy continue.
Yeah, well, I'll pass the baton now to Jeremy. We'll have a look at one of his deals and he'll talk us through what happened on this proposal.
Okay, just click the next slide on then. I think the next one is smart flow coupling. So conscious of time, so I'll keep these fairly brief. But if that next slide is showing smart flow coupling,
Don't not be my friend again, Jez.
Okay, well, not to worry. So this is a fairly young business. I think it was only in his second year, based in Hull. So we've got a potentially financially deprived area, region, manufacturing, really making liquid to liquid couplings. He'd come from an engineering background at Gary and had designed a dry coupling. This is a coupling that perhaps takes fuel off a fuel tanker and puts it into a container whereby there is zero liquid waste or any drips. And this is highly required in the petroleum sector, any transfer of any sort of flammable substances. So he was very much a designer who had created and designed an enhanced dry coupling that really had huge beneficial terms, not only to the British sector, but internationally and the petrochemical sector. And he was looking for some funding because he was starting to get contracts. Why did he come to us? He worked with a business mentor, Andrew, who you can see also in the picture there, who came across Finance for Enterprise when his bank had really not been interested in looking after anybody that wasn't turning over at least £1 million, hadn't been in business 3 years, and pretty much just gave him the cold shoulder. And that's why often somebody like that would say, well, the bank haven't formally declined me. They're not interested in helping us. Andrew came to me. As Andrew said, we got under the bonnet with the business. We could see early stage, but growing business. We could clearly see the contracts and demand for his products. And we could see a decent individual there behind him, had good equity in his home. He was living with his girlfriend at the time. So a guy who manages himself and his business good in a good manner. So he got deserving individual, you got a deserving business that's growing, and clearly he was looking for funding to facilitate growth and deliver those contracts. Now that was through taking units, so a bit of rent, fitting it out, a few machine tools that couldn't be used asset finance, and also taking on a couple of members of staff. So really it was £150,000 loan, perfect for us to help a young growing business and to establish. And the outcome of that is that subsequently Gary's gone from strength to strength. He's now in year 4, I think, now has 5 employees, and that's the sort of deserving business that we like to help, So it really came through relationships and almost being given the cold shoulder or a decline that he then found a CDFI that was interested in helping them fund their growth and create some jobs. Tim, should we have a look at one of yours?
Yes, I am conscious of the time. I'm looking at the clock and how much we're trying to fit in with the Q&A. So even though you said you were going to keep it brief, I'm going to keep it probably briefer than that. I just want to make it might be a trigger point for discussion around. When I joined the business, 90% of the referrals, if you want, into finance for enterprise came from the banks and accountants. Turn that clock forward 10 years, and if I look back over the last couple of years of my introductions, 10% have come from banks and accountants, with 90% now coming from brokers. And that's probably pertinent when I talk about the first customer. It probably won't need a screenshot on here, Andrew, anyway, because I'm very camera shy, and therefore there won't be a picture of me and the customers on it anyway.
Zoom's not working.
It's not working. So hopefully people just listen to me explain this one. It's a roofing contractor operating out of the East Midlands. A viable business, profitable, growing until COVID hit, but even that only sort of stemmed the growth, didn't cause massive issues to, unfortunately. Came out the other side with growth back on track, and then probably driven by his own customer base, which included universities, owners of old buildings. They sort of pushed him towards diversifying his business to include solar panel installation. So it came to us by a broker, I said. He recognised that because it was a change in direction of the business, and that potentially funding was going to be for increased staff, stock, etc., it's unlikely that mainstream banking will be interested. And funnily enough, one of the other reasons why another lender wouldn't do it was they were averse to lending to a sole director shareholder business. I'd not come across that before, and I don't know whether it's common, but the other lenders had an issue with that. So the financials were very strong. You could argue, well, if they were strong and it showed good profits, you know, what more did you need? But because of the diversification and move towards solar, it was a case of how's that going to affect the business? What impact would that have on the sort of cash flow? So we did ask for 12 months financial forecasts. And this is where it went a bit awry, because whether it was because the owner didn't have a relation with his accountant, perceived it was going to cost him a lot of money, what did he do? He went off onto the internet and employed somebody in the Philippines at £10 an hour to try and create a 12-month cash flow forecast. Well, I got first eyes on that when it came back, and it bore no resemblance to what he thought his business was going to do, and neither what I thought it was going to do. So he had been working with a growth hub. Unfortunately, there was an advisor there, a former accountant, who quickly picked up the reins, reshaped these forecasts, and we were able to get under the skin of that. We had a Zoom call with the accountant, the customer, to explain the assumptions behind the forecast, and what was a positive business on day one when we thought it would be easy to fund, then proved to be the case, because we could see exactly what was going to happen with the addition of the solar panel business. And we were able to lend over £200,000 pretty rapidly, having got to that stage. But the key bit I check out of this, and maybe a discussion later, is the importance, to my point of view, I'm a bit anal on this, is cash flow forecasts, not necessarily numbers, but the assumptions that come behind the numbers, so I can understand why it's going to do this in the business. So that's a very, very rapid version of the roofing contractor.
Yeah, okay, great. Another one, a bit more local to me, this was a bespoke stair lifts. And during COVID, as much as we've got an aging population and people are very house proud and want to stay out of care as long as possible, people are staying at home, and DIY has always been a strong thing in the UK, and home ownership. The growth in bespoke stair lifts, apparently, is a thing. And this client had found a niche between operating below the radar of two of the big boys, but was also being asked to install these in houses here in the UK, and even some in northern Italy, and one or two bespoke places in across Europe. Again, their growth requirement was for funding. Funding was for stock, some machinery to get some more vans out on the road, to create jobs and drivers and fitters and installers, training, equipment, uniforms, all the sort of things that, you know, don't lend themselves to securable loan proposals. Again, a lack of security. This one came to us from another lender who was providing an invoice finance facility, so they'd already maxed out on the debtor book leverage of funding available. Again, 2 directors there, good, decent people, ran fair financial positions. 1 or 2. What we do very well is, because we're face to face and we don't use algorithms, we're like old style bank managers. We often get called that, Tim, don't we? And what we say is we listen, and we go and meet these people, and they create trust and rapport, and they say, can I just tell you, I've got this CCJ from 6 years ago and it's £112 or something, you know, and we listen to the story, and there's always a story. But taking the time to listen to that means that on balance, we can still say, we still think there's a good underlying business here, and there's good underlying people. And that story is understandable, if not excusable. And yet, on balance, we can make a manual decision whereby a tick box exercise, that will just get you an immediate decline. And there's loads of examples of that. But in this case, these customers were lacking security. Invoice finance was already leveraged. They came across our website during COVID and were surprised. It was delightful to go out and meet people, because at the time it was the first time we could actually go out and meet people and not stand 2 meters away. And again, a good underlying business. And, you know, I don't need to go on too much about it, but, you know, the funding has secured the growth that the demand was driving to create new jobs, new drivers, more fitters. And just a wonderful case where, again, the business is going from strength to strength. And when he's over 2 million turnover, the banks will want to lend to this guy. The banks will want to have a relationship with them, but getting them to that stage needs help and support. And maybe we were that stepping stone. And again, it's another good example of a case where we've done something different to other lenders. We've listened to the story. We've underlined and said it's a good reason to help you, and the social impact is huge. And, you know, again, just a nice story. Tim?
Jeremy, sorry, can I come in there? Because you did mention, you know, you don't look at algorithms. I think you're probably making the point that that's maybe what the banks do. And you've all been very positive about the way that you work with, build a relationship and an understanding with a potential SME, potential business. But can I, though, look at the negative side and just say, from your experience, what does lead to you as an organisation saying no to a particular inquiry?
Well, obviously, we're not lending to every single inquiry we get, and we get people who are maybe a bit confused about whether they're looking for equity or whether they're looking for debt, whether people actually need the amount that they're looking for. Is money the solution that they want? Maybe it's not. Maybe it's expertise. Maybe it's some other support. There's lots of inquiries where people perhaps ask for money where it's not actually demonstrating it's going to create the growth they want. Only last week I had an inquiry, somebody wanting to spend a lot of money on a lot of marketing to generate the sales growth that they desperately need. And that's a little bit perhaps clutching at straws when we look at how the business has performed to date. So again, it's yes, using past and present, using fair and credible information to make good, responsible lending decisions, but also putting that against the context of the forecast, as Andrew said, forecast led. Is that credible within the context of this business? Because it may well be a business that's not made profit during COVID. Lord knows we know they've been affected. And yet the credibility of a profit forecast, it is plausible. Sometimes it isn't. And so often it's in the contextualizing of and the validity of that. And that's often where good narrative from good financial support helps. Let's go and have a chat with your accountant, or has your accountant supported you with this information? Is it fair? Is it reasonable? Is it clutching at straws? Is there some technicality in that balance sheet that we don't understand? And we're saying, can we have a word? So often accountants and good support services around businesses can often be the key to a good relationship-led application that says, this is a bit unusual. Let me explain why. And again, if we don't ask the why, then we'll never find out. And that might lead to a no. But often when we ask those further questions, we can still assess it. And we've got a credit team, but it's a manual discussion with against, and we've all got 30. That's why we've all got grey hair, because we've all got the years of experience, and hopefully that's the difference between the ones that we can leverage a yes and say, yeah, we can lend responsibility.
Okay. No. Thank you for that. And there's a question that's come through, and I think, but maybe there's a wider point that you might want to answer here. You've talked about, or one of you talked about where you get your referrals, your business.
Yep.
From. You've also talked about, the importance of an SME's accountant and the information and the support that the accountant is providing to that SME. But as an organisation, if an accountant is making a referral to you, is there any incentive for the accountant?
What you mean outside of the accountant probably charging for the financial forecast that there's going to have to provide? No, I think it's a customer. To me, it's a building more of the relationship of that accountant with his client.
Yeah.
If these seem to be integral in helping him access finance, that client is less likely to shop around for other accountants because he sees them as integral to his business. And I think that's the key bit of the team sort of aspect of working together, accountant and customer, to achieve a goal. And that's client retention. That's me. Fortunately, I've spent 15 years as outside of what I do, working with an accountant. Yeah. And as most of the people who are on this call now will probably know, client retention is one of the vital things. There's lots of people shopping around for price, but client retention on service is more important.
No, and we're all ex-bankers. 2008, the financial crisis. We all know our portfolios of customers were decimated by people closing the doors. Very few of those actually failed. What they failed to do was understand the credit cycle they were giving. So could they have had some good support, some warning signals before their next supplier let them down or their next customer let them down? Yes, they could. So we will always advocate good surrounding of good experts around you. And obviously some people don't need that, some people do. Not everybody needs KPMG, not everybody needs a bookkeeper, but it's horses for courses. And we often come across businesses that perhaps aren't with the right sort of person, or don't have that relationship where they think they could pick up the phone and ring their accountant and ask for help. That often is instrumental in strengthening a case that means we get to a yes rather than a no.
Yeah, no, Tim and Jeremy, Tim, going back to your point, I would sum that up, and I believe a good number of our practicing members, yes, they're accountants, but actually they'd want to see themselves as trusted business advisors. Mm-hmm. That they sit in the middle of their client base. So the client knows that management accounts, VAT returns, annual accounts, self-assessment, they go to the accountant. But actually, if they needed some support, some advice around funding, lending, as the example on this call is really all about, they have a network as well. So it's about, trying to do the best for the particular client. And if that means bringing in another professional, well, so be it. And the client's incredibly grateful because of the service and the advice that they will have provided. So, sorry, thank you. I can't remember who was sort of talking through a scenario before I interrupted with the question.
No, we were at a gap anyway, I think.
Yeah.
Just before I do, because there's a bit of depth in some of these things. Are we needing to finish at 1 o'clock?
Yeah, sorry. I appreciate we're sort of.
No, that's fine. I'll keep this even shorter of the next sort of, because the next sort of case study is more around understanding why we're asked to the finance as opposed to the sort of trading side of it. I mean, it is a business that manufactures pet products, if you want, pet food, dried fish. It's based on the Humber Bank, which has got a long heritage in the fishing industry. Sometimes you hear press about it's a dying industry, but there's lots of businesses still operating around Hull, Grimsby, that sort of area. Very viable businesses, maybe slightly diversified to do this. And this business does provide sort of human, what was the word? Not compatible, consumable fish turned into dried fish for dogs. Cut this story shorter, this business, growing significantly, needed to improve the machinery that was involved in the drying process. Unfortunately, it's very bespoke. So normally a guy who needs to spend a couple £100,000 on new machinery would go to an asset finance provider who would look at that machinery as part of the security for their lending. Because it's bespoke drying oven specific to the business, An asset finance provider would go, well, if this business struggled and I had to recover my asset as source of repayment of my loan, how many people in this country are going to want to buy a bespoke fish drying oven off me? So the value to them would be deemed to be minimal. Hence, I'd known this business for a number of years. We'd funded it previously, and the customer came to me, talked me through what the future of the business was. We got reliable, realistic forecasts, what you want to call them, and a clear understanding of what benefit these drying ovens were going to do on capacity, but accepting that Wide had to come to us because that wouldn't be security, and therefore our funding, I think we've done £150,000. We've utilised the Northern Powerhouse Investment Fund because there's growth in this business and jobs, and we put our own capital there as well to provide that money so that these machines can be built, bespoke, and can meet the growth this business is now seeing.
No.
So I've cut a lot of history there about the Vikings landing in Hull and doing dried fish. So that was going to be the rest of my spell. Miss all that bit out.
Okay. Look, I'm conscious of time, and let me put it out to all the attendees, please. If there are other questions that you have, please post them. You know, I know you've given information about interest rates. We've had questions about you know, guarantees. We've looked at, you know, maybe why certain applications fail. I think you've all talked about, in differing ways, the age of the organisations that you support. You know, and I think one of the examples was sort of a business in its second year up and beyondwards. You've also talked about the importance, not only to you, but to the SMEs that you support, of their relationship with their accountant and the information that they can provide. And I think, Andrew, and I think you've all talked about the sort of, well, it's the forecasts, the projections that you look for, rather than going back over, how can I put it, old historical management accounting information. So I think we've also looked at sort of timescales as well, from an inquiry coming into the funding being made available. Are there any other questions from?
Can I add something to the forecast?
Please do.
So I do become a bit anal, a bit on how it was. I see so many forecasts being sent in, which are fine, the numbers. I've never seen a forecast that says I can't afford it, but the forecast coming numbers, I rarely get forecasts with assumptions explaining why this is happening within the figures. So a lot of my life is spent going either back to the customer, going back to the accountant who may have produced and say, could you just explain why are wages doing that? Why are sales doing that? And I don't know what the people on this call's views are as to whether some of it said, I always do that. I don't know, but certainly a good percentage of what I get comes purely as an Excel spreadsheet, trying for a WIM forecast if you're old enough. It doesn't tell me what's behind them. And I love it when somebody says, here's another page explaining why that's in there, what that's doing, what that's telling you.
Okay. So it's the explanation. It's actually the
assumption is sometimes more important than the figures.
Yeah. It's bringing it to life is what
that's right. Yeah,
you're talking about, Tim. Okay, fine. No, thank you. Theodora, I question for you, and I think you answered it in your slides. Tim and Jeremy and Andrew work for an organisation up in the Yorkshire Humber region, and they've given some great examples of clients that they've helped. I'm assuming, and I think I saw a slide and a link whereby our members, those that are in other parts of the UK, where they want to connect with one of your members to link one of their clients with your members, that can be done that way. Ah, yes, I see, you've just put it, www.findingfinance.org.uk. Thank you very much indeed for that. Last comments, Andrew, Theodora, Jeremy, Tim, is there anything else that you would just like to sort of mention before we wrap up?
Well, I'll just throw in there off the back of that question, that's absolutely right. That map's brilliant, but you'll also notice there's some big gaps. And we're primarily a gap funder. We're here to help people that fall through the gaps. So, you know, if there isn't a CDFI in that region, that doesn't mean those people can't access funding. It means that we can have a look at it. I'm looking at 2 deals in Cornwall and one in Hampshire at the minute, you know, because it's the right thing to do. But predominantly we lend in our district. But yeah, just make sure that, you know, there is help and support out here. The finding website, Finding Finance page of that website is brilliant. Yeah, and hopefully everybody finds the support you need.
Thank you, Jeremy. Tim, a final comment or thought?
No, I'll just echo what Jeremy said. I think, whilst COVID has obviously affected a lot of people adversely, I think it's also been a big learning curve for our industry as well. I mean, I look at how many miles used to be on my clock driving up and down the country, getting documents signed, going to see people. Now, here I am sat where I am now, probably for the last 2 years, doing Zoom calls, team meetings, meeting people that way. So the geography isn't as critical. I'd still love to go do the old style of going and looking a man in the eyes and thinking, do I trust him? But the world's moved on. And I think we've learned a lot. We've become more efficient. And the geography boundaries, as Jeremy said, are probably not what they used to be.
Yeah, no, thank you. Andrew, Theodora.
Yeah, finance is out there. You've just got to look for it. You've got to know where to go and knock on the door. I think sometimes CDFIs are under the radar. We're not as well established as in the States, where they're part of the landscape, really, when it comes to finance. We're a little bit, our head isn't above the parapet too much, usually because we don't have massive marketing budgets. We're not going to have all our logos plastered all over the buses or sponsoring the next Grand Prix or anything like that, like some other fintechs do. So, yeah, from our perspective, it's about making sure that really the entrepreneur or the person that we're speaking to can explain that borrowing need, how that loan is going to get paid back and the impact it will have. And if we can have a sensible conversation, I thought Theo might have mentioned the Bank of Dave, because that was really popular on streaming. And we're a little bit like the Bank of Dave. It's about having that conversation and that real empathy for what that business is trying to do and buying into the figures, as Tim says. That's a very crucial bit about us for the future.
Thank you, Andrew. I'm glad you've mentioned the Bank of Dave. If you haven't seen it on Netflix, well worth a watch. Theodore, anything you'd like to sort of finish with?
Oh yeah, well, I'll just say thank you to Jonathan and everyone for having us. And I hope that, what you heard from Andrew and Jeremy and Tim is that CDFIs, they really work hard to unlock that potential for businesses. And so please do get in touch, go to our website, look us up, because I think between all of you on the webinar and the IFA's membership and us, there's probably a lot more businesses we can help. So please do look us up and get in touch.
Theodora, thank you. I think I took this from your website, by the way, but CDFIs advanced more than 228 million into the UK communities in 2021. That was apparently up 32% from the year before. So there is definitely a connection between your organisation, Andrew's, Tim's and Jeremy's, our members and the clients that they support. We will share the slides and if it's okay with everybody, we will share the recording of the session. I know somebody's already commented in the Q&A facility about the fact that it's been a very useful session. So Theodora, Andrew, Tim, Jeremy, thank you very much indeed, if you like, for I suppose an introduction to this area and actually raising awareness of CDFIs. When I was doing my research, Andrew, it was interesting. The American piece came up and then you had to delve to find the bit from a UK perspective. So if we're doing our bit to sort of raise the profile and help members and their clients, all well and good. As I say, we will share the slides and the recording. It'll be early part of next week when we do so. We will include the contact details for Tim, Jeremy, Andrew and Theodora. We will also include, or it's on the slides, the www.findingfinance.org.uk link as well. To members who've attended, thank you for doing so. Apologies for my technical issues at the beginning, and to our guests, I apologise. Their first one of 2023. It can only go upwards from my own personal point of view. You've attended a CPD session run by the Institute. Therefore, on the website where there is information for an absolute range of CPD that is coming up from this week, next week and beyond, whether that be online or face-to-face. So please do take a look, please do register. Any queries, any questions, do get in contact with the Institute. The only other thing I will say from a member perspective is renewals. Thank you if you've renewed. If you are yet to renew your membership, can you kindly do so as a matter of urgency? If there is anybody with any queries or any problems with that, please make contact with the Institute and the membership department. We are here to help. So again, to Theodora, to Andrew, to Jeremy, to Tim, to Matt Barton, my colleague, thank you all for joining us. Great session, really enjoyable. Have a good rest of your day, and we look forward to seeing you all again very soon. Thank you very much indeed, and have a good afternoon.
Thanks, everyone.
Bye all.